Welcome to the Explainer. Look, if you have retirement savings, you're going to want to hear this. We're breaking down a pretty stark forecast from economist Peter Schiff. He's warning of a crisis that he says could make 2008 look like a walk in the park, and it could have huge implications for the US dollar and the future of gold.
All right, let's just jump right into the big question, because it's a serious one that could affect all of us. Is the Federal Reserve, in its quest to fight inflation, actually setting us up for a financial disaster even bigger than what we saw back in 2008? It's a heavy thought, so let's unpack it.
So if this danger is so real, you might be asking, why isn't Wall Street freaking out? Well, according to this argument, it's because almost everyone is looking at this the wrong way. The common wisdom is that the Fed has everything under control. But what if that's just a false sense of security? What if that's the very thing setting the trap?
Okay, so here's how we're going to break this all down. We'll start with the real story of gold over the last 20 years. Then we'll get into this so-called inflation trap the Fed is in. After that, we'll look at the crisis that could be on the horizon, what that means for the dollar, and, this is the interesting part, gold's potential future in a digital world.
All right, first up, let's talk about gold's performance. You know, a lot of folks think gold's been a pretty lousy investment lately. But as we're about to see, it really all depends on how far you zoom out.
You know, if you just look at a chart from the past 10 years, it's easy to see why people feel that way. Gold's price has kind of gone sideways, right? So you think, well, maybe it's just not the inflation hedge it used to be. But that's really not the whole picture.
But watch what happens when you zoom out to a 20-year view. The story completely changes. I mean, we're talking about a move from under $300 an ounce back in 2001 to almost $2,000 just 10 years later. Yeah, it pulled back, but then it rallied to a new high in 2020. So from this wider angle, that recent flat period, it doesn't look like stagnation. It looks more like it's building a launch pad for its next big move.
So okay, if gold is really coiling up for a big move, what's the holdup? Well, the argument we're looking at today says it comes down to a huge misunderstanding about the corner the Federal Reserve has painted itself into.
And this is really where the two stories diverge. You've got the market's belief on one side, which is, hey, the Fed's got this, they'll raise rates, crush inflation, and everything will be fine. But then you have this other, much darker view. It says that the Fed's so-called cure, jacking up interest rates, is actually poison that's going to wreck the economy long before it ever fixes inflation. Okay, and to really get this, we have to talk about something called real interest rates. Now, this isn't the rate your bank tells you you're getting. It's the rate you get after you subtract inflation. So think about it. If your savings account is paying you, say, 4%, but prices are going up by 6%, well, you're actually losing 2% of your purchasing power every single year. And the key argument here is that as long as that real rate is negative, as long as you're losing money just by saving it, that's a really, really good environment for gold.
You know, think about how we got out of the 2008 mess. The entire recovery, for more than a decade, was basically built on a foundation of super low interest rates and what they call easy money. It was like building a house on stilts. Now the Fed is trying to kick those stilts out from under the house. And, well, what do you think happens when you do that? The whole thing is at risk of just collapsing. And that risk, that threat of a total collapse, brings us to the absolute core of this prediction, that the Fed is trapped. And sooner or later, they're going to be forced to do a complete 180 on their policy.
And this is where the warning gets really serious. The argument is that by hiking rates so aggressively into an economy that is absolutely swimming in debt, well, the Fed is basically lighting a match. They're setting off a chain reaction of financial stress and defaults that could create a crisis that makes 2008 look small by comparison.
So when things start to break, what's the Fed going to do? This forecast says they'll have no choice but to slam the brakes and reverse course. But this won't be a victory march where they declare inflation is dead. No, this will be a pivot of pure desperation. They'll have to fire up the money printers all over again just to stop the bleeding. And that leads to the ultimate irony, right? How on earth do you solve an inflation problem by creating a boatload more inflation? You just can't.
Hey, just a quick pause here. If you're finding this breakdown valuable, and I hope you are, please take a second to hit that like button and maybe even subscribe. It really helps us out and make sure you won't miss any of our future explainers.
So, let's play this out. What happens when the rest of the world wakes up and realizes the Fed has thrown in the towel on inflation? Well, according to this forecast, the next big domino to fall is the US dollar.
The second the Fed pivots and goes back to those easy money policies, quantitative easing, which is just a fancy term for printing money to buy up debt, it's like a giant flashing sign to the entire world.
It signals that the only option left is to deliberately devalue the dollar. And that could trigger a huge crisis of confidence, and more importantly for all of us, a huge drop in what our dollars can actually buy.
And this really gets at a classic human story, doesn't it? When a system stops working for people, they find a better way. I mean, think about it. Taxis were a pain, so we got Uber. Hotels were expensive, so we got Airbnb. When the post office got slow, we got FedEx. The argument here is that the same thing is going to happen with money. As government money loses its value, people are going to start looking for an alternative.
And this is such a crucial point, especially for anyone who's saved their whole life for retirement. The motivation to find an alternative like gold, it isn't going to be about wild speculation or trying to hit the jackpot, no. It's going to be about defense. It's about wealth preservation, just trying to hold on to what you've worked so hard for and stop it from vanishing into thin air.
But okay, let's get real for a second. We're talking about a heavy, yellow rock. How on earth is that supposed to work as money in our world of instant digital payments? Well, the answer is pretty fascinating, and it all comes down to some brand new technology.
So here's the basic idea. The actual physical gold bars are stored in a super secure, audited vault somewhere, like in Switzerland. Then, a digital token is created that acts like a digital title deed to your specific piece of that gold. You can then send that token to anyone in the world instantly and for almost no cost. The ownership of the gold changes hands in a flash, but the heavy metal itself never has to move. It's pretty genius, actually.
And this isn't just some pie-in-the-sky idea. It could have real-world benefits. When you look at the fees, using a system like this for payments could be way cheaper and faster than sending a bank wire or even using a credit card, which, as we all know, charges merchants some pretty hefty fees.
And that really leaves us with a fascinating final thought, doesn't it? In this crazy, complex digital world we live in, could it be that the key to a stable financial future is actually going back to the oldest, most trusted form of money in human history, just with a modern high-tech upgrade? It's definitely something to think about.